Open, RSM published a piece recently on data centers entering a power-constrained era. The framing was accurate. The implications they drew were not deep enough. The institutional read that most capital allocators are still missing is this: when power becomes the binding constraint on a development, the entire underwriting framework has to shift, and most real estate capital has not made that shift yet. I'm having the same conversation repeatedly with developers in Texas, Georgia, and the Carolinas. They are no longer citing projects based on land cost or labor markets, or even fiber proximity in the traditional sense. They are citing projects based on where they can get megawatts, when they can get them, and what it costs to secure that queue position. The land underneath the building is almost incidental. In some transactions I have looked at in the last 60 days, the land basis is under 5% of total project cost. The value is in the interconnection agreement, the utility relationship, and in some cases a pre-negotiated power purchase agreement. That is an energy infrastructure deal with a building on top of it. Allocators who keep running industrial comps and stabilized yield math on these projects are going to be wrong about timeline, wrong about yield, and wrong about where the leverage points actually are in the capital stack, the data layer. Let me put some numbers around this. According to CBRE's 2024 North America Data Center Trends Report, primary market vacancy across the top 7 data center markets, Northern Virginia, Dallas, Chicago, Phoenix, Atlanta, Silicon Valley, New York, New Jersey, fell to 3.4% by mid-2024. That is not a vacancy number, that is effectively sold out. Net absorption in Northern Virginia alone exceeded 2,700 megawatts in the trailing 12 months through Q3 2024. Megawatts, not square feet. The industry has already repriced the unit of account. JLL's data center outlook from the same period pegged the under construction pipeline across those same markets at roughly 5,400 megawatts, but with a critical asterisk: a meaningful portion of that pipeline has no committed power delivery date. Developers have broken ground on shells they cannot yet energize. The utility side of this is where the real constraint lies. PJM interconnection, which covers the Mid-Atlantic and Midwest grid, and therefore Northern Virginia, published interconnection queue data showing a backlog of over 2,600 gigawatts of generation and storage projects waiting for study and approval. As of early 2024, that queue has tripled in the last 5 years. ERCOT in Texas has its own dynamic, faster interconnection timelines than PJM in some cases, but low growth projections that have the Texas grid adding more than 150 gigawatts of new demand through 2030 against a generation build that is, charitably, uncertain. The Southeast, specifically Georgia Power's territory, has been explicit in utility filings and IRP documents that large industrial and data center load requests are being evaluated on multi-year timelines. Georgia Power's 2023 Integrated Resource Plan, a public filing, identified the need for approximately 6,600 megawatts of new capacity additions, partly driven by data center load growth in the Atlanta corridor and emerging markets around Augusta and Columbus. On the transaction side, Green Street's infrastructure and net lease coverage has tracked sale-leaseback pricing on powered shell data center assets in the 5.5 to 6.5% cap rate range for investment-grade tenants with long-term leases, but those comps are for stabilized, energized, operational assets. The development margin to get there, accounting for power delivery risk and timeline slippage, is materially wider than that cap rate spread implies. Real Capital Analytics data on land and development site transactions in data center corridors shows basis compression happening even on raw land. Buyers are paying for optionality on power, not for the dirt. The mechanism. Why is this happening now? Specifically, it is not just AI demand, though that is the accelerant. The structural driver is the intersection of 3 things that are all moving simultaneously. First, the grid was not built for this load profile. Data centers are always on, high-density loads. A hyperscale campus drawing 500 megawatts continuously is a categorically different grid customer than a manufacturing plant or a distribution warehouse. Utilities design their interconnection processes around smaller, more distributed industrial loads. This study process, which determines how a new large load gets connected and at what cost, was not designed for the volume or scale of requests hitting it right now. That is a process and infrastructure problem, not a policy problem, and it does not resolve quickly. Second, the generation mix is creating delivery uncertainty. In ERCOT, the growth in intermittent renewable generation, wind and solar now represent over 40% of installed capacity, creates challenges for a load that requires 99.9999% uptime. The data center operators know this, which is why they are increasingly negotiating directly for gas peaker capacity, storage contracts, or in some cases pursuing behind-the-meter generation. That adds cost, timeline, and complexity that traditional real estate development cycles have no framework for managing. Third, the transformer shortage is a real and underappreciated bottleneck. Large power transformers, the equipment that steps down utility-grade voltage for on-site distribution, have lead times of 70 to 120 weeks in the current environment. That is not a supply chain disruption in the COVID sense, it is a domestic manufacturing capacity constraint that will take years to resolve. A developer who secures an interconnection agreement today and breaks ground tomorrow may still be sitting on a completed shell waiting for transformer delivery 18 months from now. That timeline risk is not in most proformas I have reviewed. Where mid-market capital fits, the hyperscale segment, the campuses that Google, Microsoft, Meta, and Amazon are building, is not where mid-market capital competes. Those deals require balance sheets and utility relationships that are enterprise scale. The mispricing opportunity is in two specific subsegments. The first is what the industry calls colocation and edge deployment, specifically powered shells in secondary and tertiary markets where regional enterprises, healthcare systems, and financial institutions need redundant infrastructure but cannot get capacity in Northern Virginia or Dallas at any rational price. These are 5 to 30 megawatt projects, often structured as sale-leaseback or triple-net development deals with an anchor tenant pre-committed. The capital requirement is $50 million to $250 million all-in depending on spec level, which is exactly the zone where institutional capital is too large to move nimbly and retail syndicators are too unsophisticated to underwrite the power component correctly. The GP skill set required is a hybrid, someone who has done industrial development and also understands utility procurement, interconnection negotiations, and PPA structures. The second subsegment is GP stakes and co-invest in specialized developers who already have the utility relationships and queue positions in place. The queue position itself has value. I've seen it characterized in term sheets as a project asset, not just a development milestone. If you can get behind a developer who has secured a 50 megawatt interconnection agreement in a constrained market and needs preferred equity or mezzanine to close the land and begin construction, that is a different risk profile than speculative development. The queue position is real, it's transferable in some structures, and it is not something a new entrant can replicate on a 12-month timeline. Structure-wise, I'm looking at preferred equity and mezz in the 13 to 16% range with participation features, or structured JV with GP co-invest where my team controls the capital call timing and has step-in rights if power delivery slips beyond defined milestones. The milestone gating on power is non-negotiable. If the deal doesn't have a clear mechanism for what happens when transformer delivery slips or the utility changes the interconnection cost estimate, the deal doesn't close. Counter positions and risks. The bears are right about several things. The demand projections for AI compute are real but lumpy. The hyperscalers are not immune to capex cycles. Microsoft pulled back on some data center leases in early 2025, and there has been public reporting on lease renegotiations and site cancellations. If AI infrastructure investment decelerates materially, the secondary and tertiary market colocation thesis is the first to feel it, because those markets depend partly on overflow demand from primary markets. The utility cost escalation risk is also legitimate and worth quantifying. Power purchase prices in constrained markets have moved from approximately 4 cents to 6 cents per kilowatt hour 2 years ago to 8 cents to 12 cents in some recently negotiated contracts in Texas and the Mid-Atlantic. At scale, that is a material operating cost shift that compresses tenant margins and, downstream, releasing spreads. Operators underwriting flat power costs on a 10-year model are making an assumption that the current grid build-out actually delivers on time. It historically does not, and the regulatory overlay is tightening. Several states and municipalities are now imposing water usage restrictions. Data centers are significant consumers of water for cooling, and some Virginia localities have enacted or are evaluating moratoria on new data center approvals. That is a localized risk today but a trend worth monitoring. The position I'm taking. Concretely, here's what I'm doing and evaluating. I'm actively looking at co-invest positions behind 2 developers in the Texas market, one in the Austin-San Antonio corridor, one in the Dallas exurbs. who have or are close to securing interconnection agreements in the 20 to 40 megawatt range. The structures I'm evaluating are preferred equity with a 14% current pay and a participation kicker tied to stabilized value, with step-in rights triggered at 180 days past scheduled energization. The land basis in both deals is under $2 million per megawatt of secured capacity, which I think is defensible against replacement cost for a new entrant trying to get into the same queue today. In the Southeast, I'm looking more carefully at Georgia and the Carolinas, specifically around utility service territories, where the IRP filings suggest load growth accommodation is prioritized, meaning the utility has already built the policy case for adding this load and has procurement mechanisms in motion. That is a different counterparty risk profile than fighting for queue position in a territory where the utility is overwhelmed and has no formal process for accommodating large new loads. I'm also evaluating one structured credit position in a developer who has a powered shell in a secondary market, anchor tenant committed, but needs bridge capital to close out the transformer procurement and fund construction carry. That is an asset-backed short-term position at the senior secured level, with the interconnection agreement and the tenant lease as collateral. The yield profile is in the mid-teens, the LTV is below 60% of completed asset value, and the exit is the tenant's purchase option or a sale leaseback to an institutional buyer at stabilization. What I'm not doing is writing checks into speculative development with no power certainty. Regardless of how good the land basis looks, the land is not the asset anymore. Close. The summary is simple. Power has replaced land as the scarce input in data center development. That changes the GP skill set required, the risk factors that matter in underwriting, the milestone structure you need in your documents, and the comp set you should be using for valuation. The opportunity for mid-market capital is in the 5 to 50 megawatt range, in operators who already have utility relationships and queue positions, in markets where ARP filings give you a policy tailwind, and in structures that gate capital deployment on power delivery milestones rather than construction progress alone. If you are sourcing deals in this space, if you are a developer with secured interconnection capacity looking for preferred equity or a JV partner, or if you are a co-investor evaluating the sector and want to compare notes on how I'm structuring the underwrite, DM me at Brody Official. I handle those conversations directly.